Is it visible, Bhavya? And I hope I'm audible to all.
Yes, you are audible and visible. The screen is visible.
Great. Right. So, VAT, after being implemented in UAE, KSA, and Bahrain, now it's getting implemented in Oman. It's been much awaited, and other GCC countries will follow the same as per the GCC agreement, what has been entered into by the other countries as well. Right. So, what we are going to discuss today, uh, we will have how the transition of VAT, basic introduction, principles, categories, goods and services falling under the VAT. Then three main concepts which is governing the whole VAT system, which is place of supply, date of supply, and value of supply. Once you get a grip on these three concepts, then VAT is much very easy. Then we'll also look into the VAT registration as the first step of VAT. Then certain information on tax invoices, record keeping, impact on manufacturing and contracting industries. Then reverse charge mechanism, which is very important, warranty treatments, taxability of losses, input tax recoverability, penalties, challenges, impact on businesses, and steps for VAT implementation. We'll have a quick go through all these points, and whenever you have any concerns, doubts, or clarifications required, we'll have a session in between, also that you don't have to wait until then. You can put it in the chat box. We'll try to answer it towards the end of the session. Right. So update on global scenario and latest update developments on VAT in Oman. VAT is not a new tax concept in the world. It's been implemented more than 180 countries over a period of like multiple years, decades. So now it's coming slowly to the Middle East region where the whole indirect tax concept is something very new. There are very limited countries in the world where there is no VAT system. Almost all the countries have been adopted this. It is known in different names. Sometimes it's VAT, sometimes it's GST. Right now, how what grounds this VAT is getting implemented is based on the GCC VAT agreement, which has been entered into by the countries in the GCC. Based on which, as I told, UAE has implemented it, KSA has implemented, Bahrain followed the route, and now it's Oman. We have, based on the GCC VAT agreement, we have Oman VAT law, which is going to be followed by VAT regulation. And so far, the regulation is not yet out. We call it as executive regulation, and it's not yet been released yet. Once you look at the VAT law, you can see a lot of cross references to VAT regulation, and a lot of clarification is going to come in regulations. Then we will have VAT registration open during February or March of 2021. Then once registration is done, then you have to comply with all the requirements, maybe quarterly. It can be quarterly, monthly, or biannually or annually, depending on what that clarity we will get only once the regulation is out. You'll have to file the VAT return, and our responsibility is not at over. You can always expect for a tax audit from the authorities on different aspects based on different criteria. This is going to be the this is the development of VAT in the Oman. Right. So before discussing on the technicals, what is VAT? Or we call it as VAT or VAT or value added tax. As Mr. Sajeev already mentioned, it's a consumption based tax where tax is collected on incremental basis. It's not collected on one point. It's collected at multiple points of the transaction, and tax is charged only on the value added portion, not on the full value of the supply. And it's a destination based tax, and also it's known as a goods and service tax in different countries. Like in India, it's goods and service tax. Before it was VAT, now it's GST. And how does this work? How does the VAT system works? Once we understand the basic concepts or terminologies of the law, it's going to be very easy for you to uh, come along with us during the discussion and get better grip on it. Actually, the VAT is charged on the goods and services. uh, supply of goods and services. VAT is chargeable on these supplies. What is supply of goods? Passing of ownership of physical property or right to use that property as an honor to another person. You have a physical property which you're giving to another person, as simple as that. Those cases, it's a supply of goods. Then what is supply of service? Anything which is not a goods is service. It's a very broad definition. A lot of things can come into services because they are making it as like, anything under the sky what is not a goods will be called as a service and coming under the purview of VAT. But there will always be exclusions which we will see in the coming slides. We have certain terminologies like output VAT, input VAT, and net tax payable. We will see what is output VAT. Output VAT is the tax what you collect from your customers. Every business will have two parts to it, right? Your purchases or your expenses and your income, your sales. So whenever you make sales or whenever you make invoices to your customers, on which you will be charging VAT and you'll be collecting from your customers, those cases it is called output VAT. Whatever you collect from your customers is called as output VAT, right? Then what is input VAT? Whatever you pay to your suppliers is your input VAT. So every business, and I would say most of the business will have both these aspects, input VAT as well as the output VAT. Once again, to get a clarity on it, whatever you invoice, whatever you collect from your customers will be called as output VAT, and whatever you pay to your suppliers on the supplier invoices will be called as the input VAT. It's very simple concept. Then what is the net tax payable? Every end of the quarter, once you apply for registration, you will be allotted the tax period. It can be, as I told, it can be quarterly, it can be monthly or semi-annually. During this period, you have to file your return with the authority. Then what you pay to the authority, you'll have to disclose your total sales, total output VAT, and all the other information. Likewise, you'll also have to disclose information on your expenses, your input VAT, and other details. But what you end up paying to the authority will always be the difference of your output VAT and input VAT, right? That is the net tax payable or refundable. If your input VAT is more, if you are falling into a category of business where your supplies are zero rated and your expenses are always chargeable at 5%, then you will be under a position of refundable VAT refund, which you can claim back from the authority. So we have three terminologies, which is output VAT, input VAT, and net payable or refundable from the authority. Right. Moving on, we'll just see how the system works. In this transaction or in this slide, you can see we have producer, we have factory who is manufacturing, then we have wholesaler, retailer, and finally the consumer. Then the producer produces agriculture, I would say, or any raw product, which will be sold to the factory, and factory purchases it for 100 dirhams. Producer, when he's selling to the factory, he'll be charging 5% VAT on it. So 100 plus 5, 105 will be collected from the factory, and this 5 VAT amount collected will be remitted to the authority at the end of the tax period. Now, come to the factory. Factory purchases it for 105, and this 5 is the input VAT, what we discussed just now. They did the manufacturing, and the value addition is for 100, and they're selling it for 200 to their customer, that is the wholesaler. When they are selling it for 200, they are charging how much? 200 plus 5% VAT on it, which is 210, right? But what factory will pay to the authority is only the difference of the 10 what they are collecting from the customers and the input VAT which they have already paid to the producer, that is 5. So net payable would be 100, 10 minus 5, which is 5. Likewise, if you look at the other wholesaler, retailer, and the consumer, until the consumer, the business is eligible to take the input VAT, and they will pay VAT only on the difference amount. So if you look at the last column here, you can see the tax payable to the authority is only 5 for each of the parties to the, or each of the tax person. But who is bearing the whole cost of this one, VAT amount, is the final consumer or the individual who is consuming these products. So end up finally the cost is only on the burden of the cost is only on the consumer. Before he was paying 400, now he'll have to pay 400 plus 20 VAT amount, that is 420. That's why VAT is a concept where it's not a cost to the business as long as you're planning it in very good manner, and if you have a very good mechanism of maintaining documents and tracking it and accounts, then it's not a cost to your business, except in certain cases like exempted supply. So what we should be prepared is to track these input VAT, output VAT, and have a proper documentation so that you will not have to bear the cost of VAT on your businesses. So I hope how the VAT works. Right. Then we will also see what are the categories which are coming under the purview of VAT. Then we have, as I told you, VAT is chargeable or it's applicable on the supplies. On that is the goods and service. Supply of goods and supply of services are coming under the purview of VAT. So what are all the categories of it? We have exempted supplies, we have taxable supplies. These are all the broad categories of VAT under this law. What is exempt? One is exempted supplies and taxable supplies. But taxable supplies has been further brought down to standard rated or full rated supplies or zero rated supplies. So basically, we can say it as a three rates. One is exempted, another one is standard rated or zero rated. We'll have this confusion of what is exempted and zero rated. What is the difference? Exempted is again no VAT on it. Zero rate also there is no VAT. Then what is the basic difference between these two? You might have this confusion, but on the coming slides we'll have that clarity as well. First, we'll go from down and see. First is the zero rated supply. What is a zero rated supply? Zero rated supply is a taxable supply. It's a taxable supply. That's what you have to keep it in mind. Even though there is no VAT charged on it, it's a taxable supply. All the VAT provisions will be applicable to these kinds of supplies, on which tax is charged at 0% and for which the related input tax is deductible. That second part of the sentence is the most important one. You're making a supply, okay? You're making a sale for which the VAT is applicable at 0%. The advantage is that whatever the expenses that you are incurring towards these supplies for your businesses, then you are eligible to take the input credit for these expenses. That is the advantage of being falling under zero rated supplies, right? What are all the items coming and what are all the type of services with type of supplies coming under zero rated, we will see. The first one is supply of medicines and medical equipments. If you're into these categories of businesses, if you are a pharmacy or any associated businesses, then you will fall under the zero rated category. Then you have supply of investments in gold, silver, and platinum, which is again zero rated. International transportation is zero rated. Supply of means of transport for transport of rescue boats and all that is zero rated supplies. Supply of crude oil is going to be under zero rated category. Basic foodstuffs, it's in red because it's very crucial. uh, Same is like what has been implemented in Bahrain and UAE. In case if this is an exception, we don't have this provision here. It's subject to VAT at 5%. But here in Bahrain, as well as in the Sultanate of Oman, it's zero rated. But not all products. They will have a list of products which is falling under the zero rated category. You have to have a very thorough records of these items. And export of goods and services also again is going to be under zero rated category. I hope all of you are clear with what is zero rated supply. See, once again, to emphasize on it, all the tax provisions will be applicable to it as it is like for standard rated supply. Only difference is that there is no 5% VAT, but it's 0%. You are eligible to take input credit, and all the other provisions of the VAT is applicable to it, as good as it is for standard rated supplies. Moving on, we will also look at exempted supply. What is the main difference between zero rated supply and exempted supply? An exempted supply is a supply on which tax is not charged at all, and the input tax you incurred towards these expenses you are not eligible to claim. That is the difference. Those cases, if you are into any industry falling under exempted category, your sales to your customer is going to be exempt, and the expenses what you incur for your businesses or the purchases what you make are going to be non-recoverable. All that 5% is going to be your expenses, cost to the business. This is the only scenario where you are not eligible to take input credit, and you are bearing the cost of that 5% to the business. And what are all the categories, what are all the items falling under the exempted supply? It's very limited. One is certain financial services. If you're not speaking, could you please mute yourself for the benefit of others? Right. So certain financial services are coming under the purview of exempted supply, especially the margin kind of services. Fee-based services will be chargeable to VAT, but like say you have ATM service fee or bank statement fees and all that, that is going to be 5%. But at the same time, if you have any margin sales like or the interest will be coming under the purview of exempted supply. Then we have local passenger transportation within the Oman for the passengers that'll be exempt. Then we have undeveloped lands. If you're making a sale or lease of bare lands, that will be exempted. Then resale of residential real estate, provision of education and associated goods and services, provision of healthcare associated goods and services. This you might have seen in the zero rated category also, something related to that. More clarity is expected in the regulation on this part. And these are all the further items falling under the exemptions. Great. Now we have covered zero rated supplies, we have covered exempted supplies. What is left is the standard rated supply. A taxable supply at the standard rate is a supply on which tax is charged at 5% and for which related input tax is deductible. Only difference from zero rate is that the rate of tax. Zero rate it's 0%, now it's 5%. That is the only difference. And the input tax, what you incur for your business, you are eligible to take the input credit for it. So it's a broad definition once again. All supplies of goods and services other than zero rated and exempted services are taxable at standard rate. So you don't have to go around and see whether this particular supply is zero rate or this standard rate, or this particular supply is standard rate. If it is not falling under the category of zero rated or exempted supplies, then you are already under the purview of standard rated supplies. Right. Now we have this concept of place of supply. And as I told you, we have place of supply, date of supply, and value of supply based on which the VAT is governed. Place of supply rules are to determine whether the supply has taken place in the Oman or not. If the supply has taken place in Oman, then you will come under the purview of VAT. Once you determine the place of supply, then you have to look at the date of supply. Date of supply is for determining the tax point. At what point you have to pay that tax or you have to account for the tax. Then that is governed by date of supply. Towards the end, we have value supply. Value supply is where on what value you have to charge VAT, on what value you have to account for tax. That is governed by the value supply provisions. So first we'll see place of supply. As I told, place of supply rules will determine whether a supply is made in the Oman or outside the Oman. So it's as simple as that. Your only purpose of these rules are to determine the place of supply, whether it has happened in happened in Oman or not. Once you determine on that, then you can go for the next check. If the supply is treated as being made in the Sultanate, then VAT may be charged. So you decide, if you look at the transaction, you understood that okay, this transaction is happening in the Oman, and hence it will fall under the VAT. And if it is happening outside Oman, then it will be completely outside the scope of VAT. Right. Now we have, as I told you, we have supply of goods and supply of services. Place of supply regulations for goods and services are different. First, we'll look at the goods part. Right. We have basic rule. The place of supply goods is this Oman, where if the goods are placed at the customer's disposal in the Sultanate in relation to supply of goods without transportation or dispatch, or if the goods were present in the Oman when the process of transportation of dispatch started by the supplier or on behalf of the customer in relation to supply of goods with transportation or dispatch. I'll keep it simple. I'll make it very simple for you. If the goods are available in the Oman or not at the time of supply, when you make the sale, if the goods are available in the Oman or not, if it is available, then the place of supply is Oman and it will come under the purview of VAT. I don't want to confuse you by reading out the provisions. It's as simple as that. Now, this is the basic rule. If the goods are available in the Oman or not, it's as simple as that. But we have special rule when it comes to gas, oil, water, and electricity. Right? If gas or oil, water, or electricity is being supplied or sold to a taxable trader, then place of supply is the location of the taxable trader. Taxable trader are the entities or the businesses who are particularly into trading of gas, oil, water, and electricity. They have this name assigned to these companies known as taxable trader. If you are into these businesses and you are making a sales to taxable traders, then the place of supply is where the location of the taxable trader. If the taxable trader is in Oman, then the place of supply is Oman, it'll be chargeable to VAT. If the taxable traders are outside of Oman, then the place of supply is outside Oman, outside the scope of VAT. And you are in the business of supplying of gas, oil, water, and electricity, but you're not supplying it to a taxable person, I mean, taxable trader, but you're supplying to a other than taxable traders, then the place of supply is the actual consumption of these items. If it is getting consumed within Oman, it will be chargeable to VAT. The place of supply is Oman and will be chargeable to VAT. Or if you're selling it to a person other than taxable trader and who are outside of Oman and it's getting consumed outside Oman, then the place of supply is outside Oman, right? So basic rule, where the goods are located at the time of supply. Special rules, gas when it pertains to gas, oil, water, and electricity, and we have two cases in that. Just an example, we'll see a few examples here. The goods are available in Muscat and it's getting supplied to Salalah. It's getting delivered in Salalah. The place of supply is Oman and it's 5% taxable. We assume that the product is coming under the purview of 5% and it's taxable at 5%. Then the case where the goods are moving from Oman to outside the GCC, which is called as export. We'll see that it's in Oman. The goods are available in Oman, and it's getting delivered in rest of the world other than GCC countries. Then the place of supply is still Oman because it's the goods are available in Oman at the time of supply, right? In those cases, the supply will be taxable at 0%, but the place of supply is still Oman itself, right? Another example. This is very important as well. It's an exception to the basic rule what we discussed. movement of goods from outside the GCC country to Oman, which is known as import. Then, in the case of import, the place of supply is Oman if the goods are getting delivered in Oman. Like say you're purchasing something from the rest of the world and bringing into Oman. You're getting these goods into Oman, not just coming to the port and going from there, but you have to clear it to Oman. In those cases, the place of supply is Oman itself, and those transactions are coming under the purview of VAT under reverse charge mechanism. We will see what is reverse charge mechanism in the coming slides. And some this is an exceptional case, or this is very common in this part of the world where you're a distributor and you're situated in Oman. Okay, your company is in Oman. What you do is you have a customer in let's say UK, and you procure these materials from India. What you do is you ask your supplier in India to produce something, manufacture something, and get it directly delivered to your customer in UK. The goods neither comes to Oman or nor goes out of Oman. It goes from India directly to your customer in Britain. Those cases, the place of supply is outside Oman, because the goods are not in the Oman when the supply is taking place, right? So it's going from outside India to your customer's location. It doesn't come to Oman, or it doesn't clears to Oman. Those cases, your manufacturers invoice to your company is not treated as an import for the purpose of VAT, or your sales to your customer in UK will also be treated as outside the scope of VAT. So what you need to look at is whether the goods are getting cleared to Oman, and from where the goods are going to where. If you have a record on this, then your transactions of your purchase as well as your sale will be treated as outside the scope of VAT. I'm sure most of your companies will have this kinds of transaction when it comes to distribution business especially. Then we have, initially we discussed place of supply rules for goods. Now we have place of supply rules for services. Basic rule says that if you're a company and if you're providing supplies from Oman, then the place of supply is Oman. If your place of residence is Oman itself, if you have a company establishment in Oman itself, then your place of supply is also going to be Oman. And basic rules always applies unless otherwise specified in the special rules. We will see the special rules now. There are certain scenarios in which this is applicable. If the customer is a non-taxable person in another implementing state, in another GCC country where VAT is getting implemented, then the place of supply will be Sultanate. This is a bit confusing, all these provisions. I'll just go through that fast, and once we get regulations and we are discussing in depth, we will concentrate on each point and how it is applicable to your business. We'll discuss on that. Uh, Services supplied by a person that is not resident in Oman to a taxable customer in Oman. Place of supply is Oman itself. If you are into restaurant, hotel, or catering services, then where these services are getting performed, that is going to be the place of supply. Right, so you did a catering service for a company in KSA. You go to KSA and undertake these services, then the place of supply is KSA, and whatever the invoices what you're making going to make to your customer will not come under the purview of Oman VAT. We have to see separately whether KSA VAT will come or not, but Oman VAT will not be coming because the place of supply is not Oman. Then real estate, if you are into real estate business and you have real estates across GCC countries, then the rental income or sale income, what you generate out of the transaction, will be subject to Oman VAT only if the real estate is located in Oman. If you rent out a premises in UAE to the tenants and you get a rental income out of it, then that is not subject to Oman VAT because the real estate is located specifically outside the Oman. But at the same time, it's coming under the purview of UAE VAT because the real estate is located in UAE, which we'll not have to look at this moment. Then transportation service, where the transportation begins, that is the place of supply. Means of transport, where it is available at the disposal of the customer, is the place of supply. Telecommunication and electronic services, where it is actually getting consumed or enjoyed by the recipient, is going to be the place of supply. Then if you are into any event management company or cultural or artistic or sporting companies, those cases where you perform the services, that is the place of supply, and accordingly VAT will be charged. So this is the first part where I'll be handling. What we have discussed over so far is we understood the basic VAT provisions. We looked at the categories of goods and services. We also looked at the mechanism of VAT. We understood the place of supply. Now we have data supply and value supply and other related provisions, which will be handled by my colleague, Mr. Sachin. So I invite Sachin to take up the session. But if you have any questions or concerns or clarifications required until now, we can spend another 2-3 minutes for that. Otherwise, we'll go to Sachin. So, do we have any questions in the chat box?
I guess let's proceed with the next part of the session, Navneet.
Great.
Good afternoon, all. Thank you for joining us today in this knowledge session. So let me just share my screen. Hope this is visible now and I am audible. So if there is any discrepancy, let us know in the chat box. So as Navneet was explaining, these are the core concepts of any tax regimes, not just Oman, any indirect tax. These are the concepts which govern the entire tax regime. So once we master these concepts, it is easy to understand and take decisions in a practical scenario. And that's why we are giving more importance to the basic concepts. So once you get to know how to determine the place of supply or date of supply, the taxability will happen on its own. So that is the significance of all these. So as we determine how a place of supply is for one transaction, similarly, the second concept is date of supply. So the idea behind date of supply is that we have to determine when a supply actually occurred so as to remit the tax on the transaction. So we have to identify when a transaction is completed and when the tax is due from us as a registrant to the government. So that is what date of supply determines. So when to account output VAT on supplies. When we are making a supply, the date of supply will be earlier of three things. The first one being the date on which the supply was completed. So let's assume it's a service for which we have entered a contract into, and the date of supply can be the date on which the supply was actually completed. We finished doing the service, or be the date on which we received a payment. It could be either an advance or the full payment against the service. Last one being the date of tax invoice. And whichever of this falls on earlier date, that will become the date of supply of the transaction. So to simplify it, any of these things, let's take these three as independent in nature. There could be a scenario where we receive an advance for a service and later we raise the tax invoice, and even after that we provided a service. In that scenario, the moment when we receive the payment from the customer, we are liable to pay tax to the government. And it does make sense because we received the payment including VAT, so we have to remit to the government. Second scenario, where we started the service, the payment is yet to be received, and we have not raised a tax invoice. Nevertheless, we are still liable to pay the tax to government, irrespective of whether we received the payment or not. So that is where it becomes a crucial for every business to manage the cash flows also. Uh, Even if we haven't received the payment from the customer, our liability does not wear off. We cannot say that since we didn't receive a payment from our customer, we are not paying tax to the government. That will not hold up. So we have to understand this, whatever comes earlier, whether it's the service completed or the receipt of payment or the date of tax invoice, whichever comes earlier will become our liability to remit tax to the government. So that is the concept of date of supply. But there are special cases, like we cannot always say that it happens in a one-time event, like a supply. Like let's, for example, let's say a rental contract for a property over a period of time. So the service will be always continuing. It will be for an year or maybe even more than that. And there will be multiple tax invoices. There can be a quarterly invoice, monthly invoice, it's up to the contract. So in those scenarios, there are the special cases where the law specifically says there's a difference in identifying the date of supply. It still is the earlier of the following. Whenever we receive the payment, which is very logical, when we receive the payment, we got the money from the customer, we have to pay it to government. Second one, the due date as per tax invoice. So in long-term contracts, generally we see a specific date mentioned in the contract, which says that your due date, the date on which you have to make payment is such and such. It will be identified in the contract. If it is identified, it is the due date as per the tax invoice, or if it's not, the date of the tax invoice, and this is the different one. If none of this has happened, we have not received a payment, we have not raised a tax invoice, there is no due date mentioned in the contract or in the invoice, the day in which 1 year from the date of provision of goods or services gets over. So we have a time limit of 1 year. So when we provided the service, a continuous service, or entered a contract on April 2021, being a continuous supply, we have a date of supply time up to 1 year, provided we haven't received any payment or no tax invoice has been raised. So this is a identifiable, provision which is to be applied in special cases, like place of supply special rules. Date of supply also has special case in case of continuous supplies. So that is, let's see some examples. So there was some goods which was delivered to a customer. We delivered the goods and later an invoice was issued. So goods was delivered to the customer initially, only then invoice was raised. The date of supply falls on the date which we delivered the goods, not based on the invoice, whichever falls early. So that's very important to keep in mind. Another example, we received a payment. Usually in case of service industry, we see there will be an advance payment, 50% advance, 40% advance as such. And we received the payment and we began our service at a later date, and the service was completed in another 2 months. Our date of supply is on the date which we received the payment, irrespective of whether the service was started or completed or tax invoice was generated. If, since we received the payment, that will become the date of supply. Another example, there were some goods bought online. All of us buy goods from online. So we bought something on 1st May 2021. Its invoice was issued by the supplier on 1st June. Uh, then the goods was delivered in 1st of July 2021. So we bought the goods. Actually, we purchased the goods in May. It was delivered only in July. The date of supply is on the date which the goods were bought, not when the invoice was issued or the delivery happened. So that is the core concept, whichever comes earlier. The third concept, value of supply. So we have determined the place where the supply is happening, the date on which the supply is happening. So we identified whether it will be taxed in the Sultanate of Oman, or if it is taxable, when the tax is due. So both that scenarios we identified in place of supply and date of supply. The third one, if tax has to be paid, what is the value on which we will compute the VAT? So that is what is governed by value of supply. So what does the law says? The value of supply can include all the expenses. It's not just the value which you charge your customer. If it is there, yes, obviously it will be the value of the supply. But if it is missing, we can include any expenses charged by the supplier as a reimbursement, or all the taxes. So as the name suggests, VAT, value added tax, it will be the last value. So any excise duty or customs duty included in the purchase, that also should be considered as the value. And there can be scenarios where there is no monetary consideration. So in case there was no monetary consideration involved in a particular supply, the market value, fair market value of the consideration, if it's an item, the fair market value of such item will become the value of supply. So we determine all these can be a value of supply and can be the basis of computation of VAT. So there are certain items which can be reduced from the value of supply, like a discount, price reduction or discount. If your supplier is, as a buyer, if your supplier is providing you some discount, the taxable value will be the value of the good less the amount of discount. Another thing which we can reduce from the value of supply is the government subsidies. So keep in mind, these are the only two things which can reduce the value of a taxable supply. It is either a discount or a government subsidy. So when these two values are being reduced from a taxable value, that becomes your value on which tax has to be remitted. This is so as Navneet was explaining, the entire VAT in GCC came from GCC VAT agreement, and most of what we see in every country which we implemented, KSA, Bahrain, and UAE, where there are VAT already implemented, uh, most of the provisions are similar, but there are some provisions which can be, country wise. Likewise, there is something which we found peculiar in Oman VAT is value supply in case of related party transaction. So as I believe you all will be knowing what a related party is in general terms. So any supply between a related party, if there is no value which is being properly identified, because it's a related party, it may not be always in arm's length. So if it's not available, you have to take the market value for the transaction to determine the taxability. So that's very clear. If just because it's a related party transaction, you cannot reduce the value of taxable supply. If it's not the market value, the law specifically says that it should be the market value. So there are multiple confusions. Like you already, I'm sure you will have multiple questions regarding this: how to determine the related party, what if it's in a tax group and all. So we are still the Oman VAT, especially only the guidelines or the basic law has been issued. There are gray areas which we hope will be clarified in the legislation, the later regulations which are following up. So that's how it happens in every GCC country. There is a law, then there can be a regulation, clarifications, guides, and all. Shedding light to practical aspects of the law. So let's hope there are clarifications in the regulation. Now, so we identified the core concepts. Now you know how to determine the taxability on what all basis. So coming to Oman VAT, what is the registration criteria? So to register, you should know whether you are liable for registering. So as per law, every taxable person who has a certain set of turnover needs to register for VAT. So first thing we have to identify is whether we are a taxable person. So who is a taxable person? A person carrying out economic activity independently for the purpose of generating income or obliged to register for tax purposes in accordance with the law. So let's leave that part, but in the first part, person carrying out an economic activity independently. So uh, we have to identify whether the activity is carrying out in independent nature, being if you are an employee who is performing an economic activity, you are not a taxable person because you are not doing it independently. You have a contract, you are working for a company. But if you are an independent person, like okay, let's come to that. Before that, you are a person, even if you are a natural person or a juridical person. So again, coming to business laws, we know that there are natural persons, that is people like us, and juridical persons, companies, LLPs, LLCs, and all that. So individual traders, companies, whether private or public, partnerships, all that are persons. And in addition to that, individual professionals like doctors, lawyers, and all, they also are a person who is acting independently. So if it's a doctor in practice and is not employed in a hospital, he is liable for registering as a taxable person because he's working independently and generating income by performing an activity. So this is the basis to determine whether you are a taxable person. The registration applies only if you are a taxable person. So now we have determined whether we are a person. It could either be juridical or a natural person. Now, what is an economic activity? Economic activity is an activity that is conducted in ongoing and regular manner. Again, the term is important. It should be a business. It should be a profession. It should be ongoing and it's a continuous basis to generate an income. It includes anything: commercial, industrial, agricultural, professional activity, anything which generates income on a regular basis. That's an economic activity. So if you are conducting that, being a business, definitely yes, we are conducting business on a regular ongoing basis with the objective of making profit. And it should be an independent basis. As I explained before, the independent is used because employees are not covered under this, even though they might be generating economic activity income through economic activity on a regular basis. They are not acting independently, hence they cannot be considered as taxable persons. And now, if we have determined that we are a taxable person, we can register either mandatorily or voluntarily. Let's look how to go for that. So, if it's mandatory registration, meaning you have to register for VAT in Sultanate Oman, or else the authority has the right to penalize you because you didn't register. What is the condition? Every person who has a place of residence in the state meaning it's Oman, an implementing state, that is the word used in law because it's all derived from the GCC VAT agreement, but as of now that doesn't have an impact. So if a person has a place of residence, that is a office in Oman, and the value of supplies, taxable supplies, the value of taxable supplies is more than or is expected to exceed 38,500 riyals, you have to go for a mandatory registration. So there are multiple terms in the definition which requires further clarification. So it's saying the value which should be exceeding is the value of taxable supplies, not all supplies. So we have to identify what is a taxable supply. And in a threshold, the threshold is to be exceeded in a certain period of time. So that is what we are seeing right here. The period to be considered for calculating the total value of taxable supplies is total of the current month and previous 11-month period. So in the past 1 year, including the current month, if the turnover is more than 38,500 riyals, you have to register for VAT. The second one being total of the current month and in the next 11 months. You are expecting that in the current scenario, the business will exceed 38,500 riyals in the coming 11 months. You have to mandatorily register. So here, this is another peculiar thing we see in Oman VAT. Rest everywhere, it's either in the next 30 days and so on and so forth. So we have a lenient period of 11-month period for mandatory registration. So other things related to this, which will be clarified in the regulation, are what are the documents which can prove that the turnover will be exceeded. So generally that is the purchase order or a contract or any invoice which you have raised. So those are the documents which the authority will require to identify whether you are mandatorily liable for registration. So that will be clarified in the regulation. So this is the basic concept. And for non-resident person, any person who is getting an income from the Sultanate of Oman, who does not have a place of residence, but he is a non-resident supplier, he has to go for a registration irrespective of the threshold. There is no concept of 38,500 riyals for him. Even a single riyal, if he's earning from Oman, registration, mandatory registration is required for them. Now, much another concept of voluntary registration. So exactly opposite to a mandatory registration, this is an option which is provided by the authority to the registrants in the country who would like to register themselves. It's not, there is no penalty if you're not registering. It's an option provided to you that you can register for VAT considering the business expediency. Because what we see in our practical experience is once the VAT is implemented in the state, generally we see the TIN number, tax identification number or tax registration number, is asked by the suppliers and customers to do business because the input tax credit they can avoid. So that is a practical business expediency thing, but there is no penalty associated with this. You can opt to register yourself. It's called voluntary registration. And the basis of that is the turnover in current month or previous 11 months. If it's more than 9,250, you can register. You may choose to register for VAT. Or similarly, what we saw in mandatory registration, current month or in the next 11 months, if you feel that you will exceed 19 to 50 riyals, you can apply for registration. The authority will go through the application and they will grant you the TN number. So now, as I was saying, what is a taxable supply? We 38,500 is taxable supply. So whether all supplies are taxable supplies. If you remember the place of supply, what Namit explained, there was a scenario where a supplier in Oman who was uh, arranging the transportation of goods from a country A to country B with the goods without reaching Oman. It will goes directly to country A to country B. So in those scenarios, it is called an out of scope supply. Whether that can be, if I'm only doing that business where I'm arranging the transportation between two countries without the goods reaching Oman, uh, whether that can be considered for a registration threshold. So it's very clearly mentioned taxable supplies can include standard rated supplies, the local supplies which we make inside Oman, the 5% supplies, or zero rated supplies. There was a list which Navneet explained. If your supply is in that category, even though you're not collecting VAT on the supplies, you still are well within the limit of taxable supplies that can be computed to derive the threshold. That reverse charge service received. Reverse charge is a wider concept, especially considering the manufacturing and trading related activities. It's a huge concept. I'll explain it in the coming slides. If you have import of goods or services, that can well be included in taxable supply. But taxable supply does not include value of exempted supply. If you are selling a land, the value of land cannot be said as a taxable supply because it is exempt. As he was saying, that's a classification. You will have to report it, but that's not taxable. It is exempt from the purview of Oman VAT. So these are the taxable supplies. So why I was explaining taxable supplies is to determine whether you have to go for registration. And if you have to go for registration, these are the things which you have to consider. Whether you have a standard rated supply of 38,500, go for mandatory registration. If it's more than 19,250, you can go for voluntary registration. All these put together combined. So I hope that's clear. And these are the concepts which I was explaining, which we have not seen in the other countries where we implemented VAT. Let's look what these are. Responsible person. So this is, as the name suggests, responsible person is a person who is responsible to communicate with the authority in tax related matters of a registrant. And they have, in many parts of the Oman VAT, we see this responsible person specifically mentioned. And the most important one of that is that the person who is authorized to act as responsible person cannot be outside the Sultanate of Oman for more than 90 days without informing the authority. So if the, in a general sense, if it's a manager of a business who is acting or appointed as a responsible person, he has to inform authority if he is going to leave the country for a period of more than 90 days. This is, we have not seen this anywhere in other GCC countries. And procedures for auction sales. So whenever a registrant is taking up an auction sale where people can come in and, on real estate properties, they can bid and get things done. So the person who is conducting the auction shall inform the authority about such date on which the auction will happen before 10 days of such date on which the auction will happen. At least 10 days before the auction, the person responsible, not the responsible person, like the person who is conducting the auction, has to inform the authority about such procedures of this auction. Another one is notification requirements of licensed bank. This is very interesting and very significant for people, the business community who has to register for VAT. Your bank should provide documents to the authority if they request it directly to the bank. So the authority holds the power to ask the documents directly to the bank. That's one thing. So the bank has to provide the requisite detail what authority is seeking for, and the bank will inform the registrant. If assume authority is asking your details as a registrant from the bank, the bank in turn will notify the taxable person about such activity. So this is also very peculiar, and I'm sure you will understand, the gravity of that. The authority can directly contact the bank and get the details for audit, tax audit, and all that. So these are some concepts which we saw newly in the Oman law. So we also expect that there will be much more clarifications will be provided in the regulations in the coming days. We are just, the law has been released. There are a lot more to go. But as a business owner or manager in the Sultanate of Oman, you have to understand these concepts and be prepared of the implementation of VAT. That's very crucial. Now, a very important concept in any tax law, indirect tax law, is tax invoice. So, tax invoice is a document which you issue as well as you receive when you collect VAT or pay VAT. So, that itself is signifying, why tax invoice is important, because that captures the details of the transaction. It can the authority can check the invoice from your facility and derive at the taxable value and related tax. So that is some document which is right there, available in the public, which the authority can take up. So there are certain formats what we've seen in every tax law. The authority will prescribe a certain tax invoice format which your system has to adhere to. That is very important. There are penalties if your tax invoice is not following the requisite format as per law. So these are very simple concepts, and it's evident. Even now, also you would have been issuing invoices when supplies happen. It's natural to issue an invoice at the time of making a supply. But what changes when the VAT is implemented is that there will be a requisite format for a tax invoice, and you will have to adhere by the format and all that. So Article 67 of the Oman VAT law explains the scenarios when tax invoice should be issued. So when a supply of goods and services is happening, or while making deemed supplies. So at this point, you might not be very familiar with the concept of deemed supply, what a deemed supply is. The next slide is on that. I will explain in detail. Or if you're receiving a consideration, like it is mandatory when the moment you receive a consideration, if it's partial or full consideration, whenever you receive an consideration for the supply or the payment from your customer, you have to raise a tax invoice. So this is it. It might feel okay at this point, but you have to ensure that the system, when it accounts this partial consideration, it should be able to adjust it against the future invoices. So on our practical experience, what we've seen is the system will issue a tax invoice when we receive the advance. So that part is clear. But let's say we issue an invoice for the 50% of a tax invoice when we receive the payment. And on subsequent invoice for the next 50%, when we issue that, we have practically seen scenarios where the system fails to adjust the advance portion uh, and issue the value 100% value. So all that directly impacts our tax remittance and all that. Unnecessarily we'll have to face cash flow crunches and all. So as a business owner, as an attendee here, you have to be prepared for this. Your system should be capable of accounting all these. And any taxable person as a registrant, you can delegate the issuance of tax invoice to others. This we generally see in contracting companies where there will be multiple subcontractors. Some of them will be very small. So they ask the business or the main contractor to issue invoices on behalf of them. So it can be done. It's a common business practice in contracting industry especially, but you have to get the authorities approval before proceeding on delegating the issuance of tax invoice to any other person. So that is very important. And wherever there is a foreign currency involved, the tax invoice should identify the value in Omani riyals. That is the home currency. The tax invoice should identify that. So, and there is a special exception. If there is an approval from the authority, you can maintain Omani reals, but much clarifications are awaited in the coming days. But as of now, wherever foreign currency is involved, the conversion to Oman reals is mandatory. Okay. Again, as I was saying, as of now, only what the public has made aware is in format which they had, the Oman Tax Authority has issued on a guide. Other than that, the laws mention that the regulation is to clarify the data to be included, the conditions of issuing tax invoice and all that. And there's a concept of simplified tax invoice. So generally a tax invoice requires so many details, like for example, it should identify the customer's details, his TIN number and all. But there are situations practically where it might not be feasible for a supplier to identify the details of every customer, because it could be n number, it could be a wide array of customers who is coming to the shop and buying and everything. So we have seen that there are some certain leniency provided by the authority in some cases, which they will be issuing in the regulation. So generally, in case of supermarkets where unregistered people are buying, the authorities say there is no need to capture the details of the buyer. He's not going to claim it back. So all these details are what we are expecting in the regulation, and we will be conducting regular sessions for your information. Whenever we get an update, we will let you know. Now, concept of deemed supply. What is a deemed supply? So we discussed the supply, and supply is the core concept of what the entire VAT law is made upon. So what is deemed supply? Deemed supply is any supply that has to be considered as taxable supply as per law. If we look at it in a general term, we might not feel it as a supply itself, like free of cost supplies. It's very common for any business, especially let's say in manufacturing sector. You might have to give something as free of cost as a prototype for the customer, as a sample or anything. So we are not getting any consideration for that. So the first thing, disposal of goods without consideration. But the law what it's available now says that if it is provided in connection with the business activity, you don't have to consider it as a supply. Okay, so before proceeding, let me just say what happens if it's a deemed supply. So if it's a deemed supply, if it is deemed to be a supply, uh, the taxability will be as same as making a normal supply, where you will have to pay tax to the authority even if you are not getting a consideration, because the law says that this supply is deemed to be a taxable supply. So even if you are giving it out as a free sample, you might have to pay tax on that, even if you are not getting a consideration for that. But as of now, the authority has said that if it is supplied in connection with the business activity, don't consider it to be deemed. But from our knowledge, it will change once the regulation comes out. There might be a certain limit of free samples or gifts that can be given. Over and beyond that, it will be taxable. That's how we generally see in other tax regimes. So as of now, it's saying if it's supplied in connection with the business activity, like a sample or a gift, uh, it might not be a deemed supply. Then change in the intended use of goods for non-taxable purpose. Let's say the business bought a car, for example, and car is a standard supply. There will be tax which we pay on while making the purchase, which we will claim in the return. And later, the owner decided to use the car for his personal use. In those cases, it is considered as deemed supply. You will have to reverse the input tax which you have already claimed at the time of purchase, because the nature of its use have changed from taxable to non-taxable. And if a company is going for liquidation, there will be inventory in hand. There will be closing inventory in hand. So when we are liquidating, we have to consider this as self-consuming, and we have to reverse the credit which we have already availed on these inventory at the time of purchase. So basically, we'll have to reverse it, but it is deemed supply. We are making a supply, and tax will be due on that. So, and as an exception, let's say in this case of car, in that example, if the business, we had a hunch that the owner might use it for the personal use of his and his family, we didn't claim, as a business and manager of the business, we didn't claim the input tax while we purchased the car. In those scenarios, even if the taxability changes from taxable to non-taxable, we might not have to uh, treat it as deemed supply and pay VAT on it. So these are core concepts. We have to understand that even if we are making a supply without receiving a consideration or a sample, right now we don't have any liability. We just have to mark the inventory moving out and all that. But when the tax is in question, we have to determine whether that is a taxable supply, whether tax will have to be charged on that, whether we have to charge tax on ourselves to report it in the return and all that. It's very significant. So aware of this concept of deemed supply. Now, this is the tax invoice sample which I was mentioning. This is what is available in the website of Oman tax authorities. This is not final. We are expecting much more clarification once the regulation is out. But for your understanding, these are certain items which we see in every tax invoice. Like you can see the buyer details, his TIN number, date of supply, and invoice number, and all that. So these needs to be captured in a tax invoice. So your system, as a tax registrant, your system should be capable of raising tax invoices in these formats, or it can lead to a compliance default. Record keeping, very important, especially in contracting and manufacturing industries. A taxable person shall maintain records of all goods and services supplied, your supplies or the imports you have made. So for imports, it might not be a one record, it could be multiple records. There will be a customs record, there will be a record from your supplier, there can be, we don't know at this point, there can be a payment receipt which you will have to maintain if it is paid directly to the authority and all that, and details of all the exports. Even for exports, there are multiple documents which you'll have to maintain. And books of accounts should be always made in Omani Riyals, except there should be a written approval from the authority where you can maintain in any foreign currency. So why I am again, emphasizing on these points are because we have to be assured ourselves that our system is capable while implementing VAT. Our system or our business is capable of having all these documents. I'm sure we all are recording documents, but there should be an order because the authority can ask these documents every record for a period of 10 years. So in UAE, it's 5 years. In Bahrain, I think it's 10. So in the 10 years from the implementation of VAT in Oman, the authority can request any of these records. So that is very crucial. Some of these records, practically, let me tell you, the ink in the invoice, it can fade away. There are situations like it might not stay for 10 years. So you will have to find an alternative solution for this. So these are some practical experience which we have. These are things which you have to take care. So a period of 10 years is a longer period of time. You have to maintain every record. So very significant. And for construction related in the real estate industry, the record keeping time period is 15 years. Very crucial. Subcontractor, there can be subcontractors who are not registered or very small operations who might not be able to provide requisite formats. As a registrant, you have the liability to maintain every correct record. Extra care has to be taken in this regard. Now, today's, let me take you through some of the things which we see in manufacturing and contracting sectors related to VAT. And also, we can have separate session for each industry later on, even once the regulation is out. These are just to give you a heads up as a manager or a business owner. You should be aware of these scenarios because you have to get prepared. Now, it's hardly 5 months for the implementation of VAT. It's right time for you to implement the proper tax system by understanding the law. So that is the objective. Now, what is a reverse charge mechanism? reverse charge mechanism is where the recipient of goods or services is liable to pay VAT instead of the supplier. Consider a scenario where you are making a supply as a registrant, you are making a supply to another person in Oman. Who is liable to pay VAT to government? Even if the customer is not paying the VAT to the supplier, that is you have the liability to pay the tax to government. That is called forward charge. You will collect it from your customer, you will pay it to the government. But in case of imports, what happens is the person who is selling to you is from rest of the world who does not have to comply with the provisions of Sultanate of Oman. So the law says that instead of forward charge, the recipient of goods, the customer, has to pay VAT instead of the supplier, because the supplier does not have any registration in Oman. Rather, the customer, he will pay VAT and he will claim it back. That's why it's called reverse charge. So forward charge is normal, and reverse charge is when the recipient himself charges VAT on himself. So that is reverse charge. Why reverse charge is very significant for manufacturing industry is because uh, you have to keep track of every import you make, every document related to import, because import is something which comes from outside the country. Hence there is an involvement of another judiciary person, that is the customs department. They are also involved in the transaction. They will issue, they will verify your thing, you will pay VAT while importing, and you have to reconcile. There could be value differences between the value picked by the customs and what you pay to the supplier. These are, I'm telling you these from our practical experiences. So all these can happen once the law is implemented. So as a business owner or manager, you have to prepare yourself to reconcile your records with the customs records, and you have to identify the documents which pertains to an import. The taxable value of imported goods, that's what I'm again saying. The taxable value of the goods is not determined by a tax registrant. It is determined by the customs according to the common customs law. So your value, what you paid to the supplier from outside, could be different from the value picked by the customs. There could be exchange rate differences or customs duty differences and all that. So you have to reconcile these differences before proceeding any further. So that's why reverse charge mechanism is very crucial for be it trading or manufacturing. You have to, because unlike a normal input tax, you have to use your number in customs department to link all that. So practically we will have a separate session on input tax, I mean import of goods and reverse charge alone, because that's altogether a different ball game. So understand these four now. So when is tax due on imports? So generally, when an import is done, it will be the date on which the goods were imported. When it clear the customs port, when it comes through the customs, that will be the date on which you will have to pay VAT on it. Or this is a special provision which requires, as of now, it's a gray area in the law. The date on which the goods reached first point of entry. That's the term the law uses. The first point of entry. So if it is in the Sultanate, if the goods are directly coming from rest of the world to the Sultanate, the date on which the goods reached as in the first point when it reaches the Sultanate. But if it is coming through, let's say a good is moving from India to UAE, then coming to Oman, and if you have the documents which can prove that tax was paid in such GCC state, you might not have to pay tax, the VAT on import of goods in the Sultanate of Oman, provided you have the documents, and those documents are yet to be clarified what these documents are. So that is one thing. And if the goods are in custom suspension, so there is a concept of custom suspension. This is nothing related to VAT, it's purely customs. When the goods are reaching the port, they will keep it in a custom suspension, and after a few days it might be released. In those scenarios, when the goods were in custom suspension and is released at a later point, it will be that date on which such goods was released from custom suspension on with the taxes due. Now, what is warranty? So as warranty is very significant for trading, you know what a warranty is. I'm just giving you a definition right here. uh, Guarantee, it is a guarantee which is issued to the purchaser by a manufacturer promising to repair or replace in a specific period of time. So I'm just that's the proper definition of warranty. You all know what a warranty is. So what is the confusion? So, warranty, when a dealer is offering a warranty, generally what we see is at the time of purchase itself, it will be mentioned that there is a period of warranty and the price will be included in the first sale itself. There won't be any additional price for the warranty. So the law says is it is out of scope of VAT. There won't be any tax for the warranty supplies. If it was exchanged during the period of warranty, there might not be any tax due because it was already covered at the time of first sale. But if it is additional warranty, you have to pay for additional warranty. Like let's say in case of purchase of an iPhone, you can see you can opt for an additional warranty. In that scenario, that warranty will have to be charged 5%. So there have to be clarifications which has to be received on this. But what you have to understand is warranty depends on the nature of contract of how it happens. So if it is part of the first supply, it becomes out of scope, or if you have to pay additional for that, it becomes taxable. And I can further complicate this by saying there is a concept of third party warranty and all that. But let's not venture into all that at this point. Let the law also come. We don't want to go ahead and contradict the regulation if it when it comes public. So understand these concepts. These are very significant in manufacturing and trading industries. So what is a retention? As managers or business owners in contracting industry, you might know what a retention is. So retention is something which a supplier holds back to pay to the supplier at the time of entering a contract, because he wants to ensure that the contractor performs his obligation under the contract. So assume a construction contract where the contractor will enter into the agreement which says that there will be defect liability period if after the completion of the construction, if at all there is an error or a mistake happened, I will cover it without any cost. So that's called defect liability period. So the concept here is, if the retention payment falls like this retention can happen, the defect liability period or the retention period could be years, especially considering contracting. It's a construction of, let's say, high story building. Uh, the defect liability period might be years altogether. So let's say a scenario where the construction was completed in December 2020 and the retention will be due to be received only in 2025. It could happen. So in that scenario, whether we have to decide whether the retention at that point of time will it be taxed or not. So what we generally see in GCC Common VAT Agreement, if the construction is completed before the date of implementation in Oman, 1st April 2021, if the construction is completed and we have a sign-off agreement which the contractor and the customer have sign off saying that the contract is ended, everything is performed well. In that scenario, whenever the retention becomes due to be received, it will be out of scope of VAT. But you have to enter, if you are into a contracting company, you have to review your contracts right now and decide if there is a sign off agreement which will be done, or if it's not done, whether how the retention will be taxed. All that you have to decide. So these are the prerequisites which we have to check now before the implementation of VAT. Now, laws. Any industry can have laws. It could be either normal laws or it could be an abnormal law. So what is the tax treatment? So when a normal loss happens, it might not be considered as deemed supply. So the word we have used very carefully, may not be, because the law has not specified anything on this as of now. So it will not be considered as deemed supply, considering the GCC VAT agreement and what we've seen in other GCC states. But it is very significant that you have to define what a normal loss is. So assume an electronic industry, a trading industry, where the normal loss might be higher than other industries because of obsolescence. And as a business owner, what you have to do right now is to compile a data to determine what your normal loss is. So when you are saying something is your normal loss, you have to satisfy the authority that this in fact is normal in your industry. So you might have to keep documents for that. We suggest, even taking photographs, the expiry, all that. So it is not defined in the law. This is from our experience what we are saying, that these should be done. In case of abnormal loss, that is most normal loss, we'll have the data. I hope you have the data for a normal loss to quantify the amount of normal loss which is happening. But for abnormal loss, we cannot have a previous data. That's why it's called abnormal loss. In those scenario where it is covered by insurance, a fire which is covered by a fire insurance, and you are getting money from the insurance company, it might not be taxed because there is no supply which is happening between insurance company and yourself. It is just a compensatory payment, so it will not be taxed. But in case where there is no insurance coverage, we'll have to see how the abnormal loss has to be treated once the regulation comes out. So these are the areas which we are also expecting the authority to clarify in the regulation, how the tax treatment should be. So just we can say that just because it's an abnormal loss, it will not be taxed. So you may be asking how there is no supply which is happening, so how can we tax? So the answer for that is the deemed supply. We have to the product became, and so at the time of liquidation, as I was saying, what we hold which becomes unsaleable, that becomes taxable. So that is one thing. So these are some things which are important to identify at this point. And for transitional provision is certain provisions which is applicable from now till the implementation of VAT. Because let's say assume a scenario where when tax is coming in April, there can be situations where people are thinking like, if we invoice them now, and let's invoice all the customers next year right now, so that we will avoid paying VAT. So the authority is well aware of that. So that's where they brought about the transition provision, which says if the supply was made after the effective date of law, that is 1st April of 2021, it becomes taxable. Even if you raise an invoice now or you receive a payment for that now, but the taxable supply, the supply was happening after 1st of April 2021, you have the liability to pay tax on that. So that's what the second code, where even if you have received the payment for the supply right now, you completed the service or the supply of goods in December 2020, but your customer is paying you in May 2021 after the implementation of VAT. No tax is due because your supply was completed well before. On the other case, where the supply is completed only after the introduction of VAT, that's April 2021, you still have the liability to pay VAT. In case of continuous supply, as we saw in the date of supply, continuous contracts are which is already in existence. So in that scenarios, if we have a proper sign of agreement which says this portion of service was completed before implementation of VAT, the tax on that part will not be due even after implementation of VAT. Or let's say 80% was completed now, 20% is completed only after the implementation of VAT. Tax is due on this 20% of what you are completing after the introduction of VAT. Now, moving on, input tax, the concept of input tax. So let me just take you through what your eligibility to claim input tax is. Whenever you make a payment or you receive a tax invoice where you account for the input VAT, you can claim it in the immediate subsequent return. So assume you receive something in April of 2021, a tax invoice from your supplier, you can claim it in the next tax return, your first tax return. So that is the eligibility. If you are a registrant, you are eligible to take it. Non-recoverable input tax. So there are certain things which the company as a registrant cannot avail input tax on. One of the thing being personal expenses. Assume the owner of the business bought a sorry motor car in the company's name. The invoice is raised in the company's name. The payment, it happens in this part of the world where the owner's personal expenses might be met in the business account itself. So in those scenarios, the input tax which we pay from the company cannot be claimed because it is a personal nature, or if it is related to exempt supplies. As Navneet was explaining, the exempt supplies are not considered as taxable supplies, and hence the input which you pay for making exempt supplies cannot be claimed. And there's a concept of prohibited goods. So upon our inquiry in the customs, we understand that there are certain items which is prohibited to be imported to the Sultanate, like animal skins, ivory, I believe explosives and all that. So these goods, it is illegal to import. So the input tax which you pay on that is definitely non-recoverable. The time period for input tax recovery. Let's say you missed out to account, or you didn't receive a tax invoice from your supplier even after you making a payment. So we have to determine till when we have the eligibility to claim the input tax on such payments which we have made. So the Oman tax law has been very lenient on this aspect. Up to 3 years from the date of your eligibility, that is the tax period from which you become eligible, up to 3 years, you can take it forward. In UAE, it's 2 tax periods. In Bahrain, it's 2 tax periods. And other than that, there should be a separate provision altogether. But in Oman, it is 3 years. You can keep an invoice for the claim up until 3 years. So that's very lenient from the authority. Now, I'm sure you are very eagerly waiting to understand what the penalties is. Let me just quickly take you through. There are 2 articles which discuss about the penalties as of now. That is 100 and 101. 100 discuss about the violations of responsible person if you fail to nominate a responsible person, or the responsible person fails to submit the tax return, or not issuing the tax invoice. That's where again the significance of tax invoice. It is a penalized, or you are liable for penalty if you are failed to issue a tax invoice. And what is the penalty? The penalty is minimum 1,000 riyals up to 10,000 riyals, and there's a prison sentence of not less than 2 months and not exceeding 1 year. And if it's repeated, the penalty is double. And Article 101, it's much more severe penalty, much related to evasion and not registering and submission of incorrect returns, not providing data when the authority asks for it, and that is where the prison sentence is 1 year minimum and up to 3 years, and the penalty is huge, minimum 5,000 and a maximum of 20,000. So these are the things which you have to understand at this point. And we definitely will have a very detailed session on every aspect of the law for your understanding. And we have to prepare for a smooth implementation of VAT in Oman on all your businesses. And we are always there to support you. And just for your information, these are very few of our clients whom we have successfully implemented VAT across GCC in, uh, you know, from the date of implementation. So that's it from me for today. We have a few more slides where now it will be taking you through the importance of implementation, steps in tax implementation, all that, very significant. So if you have any queries, let's hear it now. And these
Sachin,
points, yeah.
yeah, there is one query from Nadeem. I think you've cleared it, but I'll just repeat the question.
Yeah.
He's asking the VAT treatment in case of manufacturing of a big equipment. That is, if it qualifies as a continuous supply and which has a milestone payment terms. Say if it is
Got
say
it.
if
Yeah.
80% of the payment is received by raising the milestone. before April 2021, and 20% is to be raised after the shipment equipment, which will happen after April. So address that.
Yes, we have to determine when this supply is getting completed. So it is, as I was explaining, it is the supply which is basis of the taxability. So if it is happening after the introduction of the contract is completed, only after that, to that extent, it will be taxed after implementation of VAT. So I hope that's clear.
Right. So any more questions we have? Otherwise, we'll go to the last part of the discussion. Sachin, I'll just share the screen now.
Yeah, I will just stop it now. Thank you.
Right. I hope it's visible. Right
One
now,
second, we have a question, I guess, from Mr. Paul. Just a moment. Mr. Paul,
Yeah,
Parimal, I've
hi.
unmuted. Yeah, yeah.
Yeah. Actually, I want to ask about that on the advance payment. It was told that we have to pay the weight, right?
correct,
So advance payment means uh, like the invoice is 100%, but advance payment is not 100%.
correct.
Then I think the VAT would be on like it's 25% or 50%. So we have to pay the VAT on 50%, right?
Correct,
Not
correct. Yes.
the full amount.
No,
Not the
no,
full
or
no.
amount.
or
Whatever the
either
advance.
or either see the that can also that any lump sum amount is received, not any percentage wise, but the lump sum amount, then how can we do it like that?
See, what you need to look at, sir, is that how much you received as a consideration. It can be percentage based, it can be a lump sum amount, as you said, but whatever the amount you receive to your account, on that you have to account for tax. It's as simple as that. It's not. It need not be percentage itself.
Okay, I think in India it's in GST it is like that, that what amount you received, on that the whatever the 18%, 5%, whatever it is, that is being calculated, and that
That is
tax
same
amount
as
is being paid.
correct, sir. Same is the case here. So with the amount you receive, on that you have to pay tax on it. If you let's say you raised an advance as per the contract, I'll give you a scenario where the contract says 10% advance. Okay, hello, can you hear me, sir? Hello.
Hello.
Okay, can you hear me?
Yeah, yeah.
Right. I was trying to give you an example where your contract says 10% is the advance, and you raised a 10% invoice, which is coming to 100,000 reals. But when you received the payment, you received only 80,000 reals, right? The tax that you need to account for is on 100,000 reals because you already raised a tax invoice for that. Assume that you have not raised a tax invoice, but you received 80,000 reals, then what you will account VAT is only on 80,000, not on 100,000. So that is a difference. And what you need to be sure is ultimately what you received in your account as advance, you have to pay tax on it. Or if you, whichever is higher, if it is invoice amount is higher than the received amount, then you have to account for VAT on the invoice amount. I hope that
Still,
answers.
if it is not, if it is the full amount is not received.
Yeah, yeah. Whatever the amount you received, or if you raised invoice, then on the invoice amount, or if you received the payment before invoices, then on the received amount.
Okay. If the invoice is not generated, then on the receipt amount, right?
You're right.
Yeah. Okay. Okay. Okay.
Great,
Thank you.
great. Right. Now we'll broadly look into the current challenges that we have because of VAT. Now we have registration related issues by determining the threshold, achieving the threshold, what's your revenue in the past 12 months, and qualifying for mandatory or voluntary registrations. That is going to be a challenge. Then we have a VAT group related, whether a tax multiple companies owned by the same group needs to be grouped or not. That is going to be a challenge. Then we'll have cash flow effects on these transact businesses. Then import is going to be a challenge. Then the implementation of VAT by micro level entities, not just micro, any kind of entities in the industry needs to have a very are going to face challenges when it comes to the implementation. Then wrong interpretation of the law, it's a major issue where people make the calls on their own and go for the interpretation, but after some point of time they realize that okay, what the treatment what they have adopted is wrong, and they will end up paying huge penalties. So these are all the major challenges. Then the impact on your businesses, basically it has impact on basically on everything, right from the procurement to sales and marketing to finance to all departments are having an impact on this thing because of VAT, right from the vendors pricing to pricing strategies to on your sales to bad debts and human resource. How do you give certain things to your employee allowance, what is the treatment of employee allowances, and legal matters, contracts, when you enter into contracts having the clause of VAT in it, that is very important. Then we have major challenges IT also. Your system should be capable of maintaining the information as requested by the authority, uh, which can have all the information of the tax invoice, like tax invoice number, date. Your system should be capable of recording this information, capturing this information, and should modify it accordingly, especially the layout of tax invoice, point of taxation, capturing it in the VAT reports. All that is very crucial. And your modification of IT or your ERP or accounting software is very essential even before the implementation of VAT. And how we can assist you for the VAT implementation basically is right from understanding your organization structure, and by understanding the business operation, what's your business, what are all your activities. Then understanding and analyzing the impact of VAT on your business on different divergent areas, right from, as I said, procurement, what all strategies you should be adopting for smoothing the procurement processes, and what's the impact. We'll be doing a thorough analysis of it. Then we will also evaluate the opportunities or options for restructuring the current practices, how to modify it to comply with the VAT requirements. Then we need a contact person in your company whom we can communicate these information, and is going to be the point of contact. Then we will also suggest the changes to be made in your IT documents and processes, what you need to change, and a detailed report will be issued with respect to that. Your supplies, whether it is exempted or standard rated or zero rated, and will also be assisting you to determine the recoverability of these expenses. Then we'll also have a trial run for before we go live on 1st of April, because that's very essential. Then we'll also support you until filing your VAT return, first VAT return. So right from the understanding your structure to filing the return, and of course, if you're willing, we will be taking up the, return filing, subsequent return filings as well. So this is how we can support you for. And I think with that, we can conclude today's presentation. Bhavya, anything to add on, or if they have any doubts, we
Yeah.
are here.
So I'm just putting on a contact number and an email ID in the chat box. Even if anybody has any kind of queries post this session, please feel free to come to a contact on these contact details, so that we can assist you with anything further needed. Sajeev sir, is there anything else?
Any questions? We can take any questions. So anyway, we'll be
Yes, sir. I have one.
Yeah.
Aman here from Al Hashmi Law. Maybe my question is with Sachin. Sachin, I understood that the tax point is the invoice, the date of supply, or the invoice date, or collection of money, whichever is earlier. So in my case, I'm going to practically face the situation after some time. In my case, I'll invoice in a date which will be 100% due, and I'll expect the payment after maybe 4 or 5 months. So the amount will be huge. Any option for me to drag the tax liability until I receive? Because is there any option to make any other invoice other than tax invoice so that I can delay the tax due until I receive the money?
Let me just understand if you will be providing the service before receiving the payment or receiving an invoice, or that
Yes,
will.
of course. As per the contract, the money is due on signing the contract. Maybe it's a legal consultancy firm. The due on signing the contract, the an amount will be due. So I hope VAT has to be collected at that time.
Yes. See, the thing is, since you are providing the supply of service, even that scenario, your tax will be due at that point. But let's say, for clarifying the doubt, let's say if it was only the invoicing which was done and the payment was raised at a later date, you could issue a pro forma invoice instead of
That's
a tax
okay.
invoice.
Fine.
You
Fine.
can inform this customer about their payment due and pro forma invoice. But since you're already starting to provide the supply, that also will trigger up your liability.
Yeah, just to
That's
add
right.
on, because the contract specifies about the the tax point or when the consideration is due, then of course you cannot defer the payment of tax to the authority. You will have to collect it at that point of time itself. You cannot wait until
Collect the
receive.
money.
Receive it.
Yeah. Right. Clear. Thank you so much, guys. And you both were really excellent. And thank you, Sajid, for coordinating this wonderful session.
Thank you, Aman, for joining.
Welcome, Oman. Thank you. Thank you, Oman.
Also, if any one of you has not put in their company details, it'll be great if you do so that we can come back to you and follow up with you all. So that'll be really helpful if you do so.
Since we know most of them personally, so we will get back to them personally and we'll be in touch with them. And thank you for joining. And from FinPro, our team is ready and we are always available to serve your business. And as Mr. Navneet and Sachin mentioned, the understanding the business and early start is very important, basically for corporates, understanding the structure and complexities. It's not only the registration and filing of return. It's basically your business has to be equipped with many other things like your IT infrastructure, your employees should be see as we mentioned. It's not only the finance job, or it's not only the question of finance or accounts. They should understand the VAT. It's all aspects of the business should understand the minimum understanding of VAT compliance requirements, whether it is purchase, whether it is sales, whether it is admin, HR, all the departments should play a vital role in the smooth transition to VAT tax regime. So in that perspective, we request everyone to get into the early preparatory mode. Pre-implementation, probably the preparation is very much required. To get in touch with us, the coordinates are available. So we will, since you all are one-on-one contacts, so we will get back to you also. Thank you so much for joining, and we'll be in touch. Thank you so much. Bhavya.
Yes, thank you everybody for joining. And with this, we conclude the session. So yeah.
Thank you.
Thank you. Bye.
Thank you. Bye.